You heard what Steve just said about J.P. Morgan's prediction that the economy could go negative in the first quarter. What's your reaction to that?
Yeah, I mean, I fully agree. And not only do I agree, but Kelly started talking about, double dip. And I have moved from the W recovery to the double dip camp because I do think we're going to see negative growth. And I'm not sure we'll rebound as quickly in the second quarter as J.P. Morgan might suggest. I do think we have many hurdles. And again, Tyler, as we've talked over the last many weeks, I don't think the stock market is the vehicle through which we can assess the damage on Main Street. It really, they're two different worlds as far as measuring outcomes is concerned. When it comes to big companies that are aggregating more market share, that are doing better, surviving and thriving during the crisis, we see that reflected in publicly traded stocks. When we see mom and pop businesses going out, restaurants shutting down, and all lockdown measures and other sorts of activities that are being curtailed as a consequence of the spread of the illness, that's just not reflected except in the truly macro sense. And even the bond market isn't really selling off on that. So I think financial markets are divorced entirely from the Main Street reality that's going to hurt small business mightily over the next many months. And the stock market's going to do what it's going to do.
Basically, Ron, I hear you saying here that the stock market is measuring or forecasting a totally different economy than really if you looked at the U.S. economy writ large.
Yeah, and I think when you look at specific sectors of it, Tyler, so if you talk about Main Street per se, so you talk about mom and pop businesses, small retailers, you talk about those who are unemployed and losing skills, who have to be retrained and re-educated to enter a workforce that's changing more rapidly than we ever had considered. They're really two different sets of issues they're being played out on these two different streets. And so I don't think one reflects the other's reality. And in one case, it's perfectly legitimate to talk about what the stock market's doing, just as it is to recognize the damage that's being wrought on Main Street because of the pandemic and the response.
And yet, Mike, in your survey for UBS, it would seem that most of these investors you talk to are pretty optimistic. I mean, that's the way I read it. They're getting ready to put money to work. They feel pretty good about the economic growth. This survey was taken right after the election. They don't seem freaked out at the prospect of a Biden administration.
So first of all, Tyler, let me follow up on something that Ron said because I have a slightly different take. I don't think that Wall Street is completely divorced from Main Street, but I do think it has a different discounting mechanism. I think what we're focused on is not necessarily the short-term economic pain, which I agree is going to be significant, especially as we see COVID restrictions reimposed. But I think what the market's also focused on is the massive mobilization of fiscal and monetary resources and the implementation, which we're likely to see some point in 2021, of a vaccine. So I think that combination is what they're looking for. And therefore, they're focused now on the economic recovery process that they believe grows in 2021 more robust. And then also what it means in terms of your earnings recovery. So for me, I'm not sure that the markets are divorced from reality. I just think they have a slightly longer timeline.
Shepard Smith here. Thanks for watching CNBC on YouTube.